As Romain was showing us in that chart, IPOs are subdued versus the same time last year and certainly versus 2021, and secondary offerings are also slowing down as well because a lot of companies' currencies, their stock prices have fallen so much. So what's the case for why companies would sell equity now versus, say, selling bonds when there's so much demand for fixed income?
Yeah, I think as we think about the markets, generally speaking, equity is and tends to be an alternative along with debt. Everyone's cost of capital just went up, bonds and equity. So I think it really depends on what kind of company you have, what kind of cash flow you might be generating, when you're planning to turn profitable. But when we think of the markets today, I would say that year to date, no surprises in terms of the current market conditions. We've been able to raise $1.7 billion for 17 operating companies, and the deals have actually performed relatively well, I would say. Yeah. We also had the largest corporate spin out with GE Healthcare, which did quite well.
Which is interesting. That's one of the biggest listings you've had this year, along with Nextracker, but neither of those are tech, and Nasdaq is kind of known as this tech-heavy exchange.
Well, I would say that's a misnomer. We do more than tech. There's a lot of interest, I would say, across the board in this environment. Clean tech, I would say, is quite popular. Energy is quite popular right now, just given the current market conditions. And we're expecting to see, I would say, some good spin-outs, corporate spin-outs like GE Healthcare. Of course, we had Mobileye last year, was one of the bigger ones. And we're also expecting to see quite a bit of private equity flow this year.
Well, so the spin-outs, and when there's been a lot of speculation, we don't have to go through it, that Bloomberg has reported on companies that are ready to tee up a few of those names here. We've also seen a lot of activity in terms of just general secondary offerings as well here. What's the balance that you're looking to for the rest of this year between the actual initial public offerings and some of these secondary offerings? Yeah,
so one of the key indicators that we look at is the VIX, which measures the volatility in the market. The VIX has been trading between 23 and 19 for the past 3 months. That's a really good sign for the IPO market in terms of receptivity. And what I would say is about 90% of companies go public when it's 25 or below, and 95% of companies go public when it's at 20. Or below. So it's at 19 right now. It's been at 19 for a while. And when you look forward, I'd say we've got about 200 companies on file looking to access the market, super high quality companies. And we have more and more companies coming to us and saying that they're getting ready to dust off their IPO preparedness.
So this gets to the idea, though, it's not just about sort of aggregate conditions. It really is about the volatility of those conditions.
Yes, and then I would say when it comes to the IPO market, companies need to, I think, reassess their valuations, right? They may have raised capital at a much different valuation. And when the markets move the way that they have based on the fact that your cost of capital has changed materially, that impacts valuations.
And we're seeing that reckoning right now in the private marketplace. I am curious, though, but even before we got to the pandemic, there was a big boom, I guess, in people trying to find different ways to market, basically circumventing Nasdaq, NYSE, or at least a traditional process, I should say, not necessarily circumventing you guys, but circumventing more importantly the investment bankers, if you will. So we saw the boom in SPACs, we saw some of the direct listings out there. Do you think that when we get to the backside of whatever we're in right now, that we will see, I guess, a re-engagement in those types of vehicles to get to market?
I do, actually. And we just had our direct listing with a capital raise approved. And I think we're very optimistic that companies will use that as an alternative.
And you have what you call an elegant solution for companies that do want to pursue a direct listing with the Nasdaq. I'm curious as to financially what a direct listing means for the Nasdaq versus a traditional IPO.
We're indifferent. It really doesn't matter to us. It's just an alternative in terms of accessing the public markets, and it's really up to the company on how they want to do that. And the fact that we now have a solution to raise capital and do the direct listing, I think, is a real alternative to the traditional IPO.
There has been, in certain pockets of the capital markets, we've seen some degree of consolidation among some of the exchanges and some of the other players here. Do you anticipate that we could see more activity in that space, not necessarily specific to you and your company, but just overall?
You know, this is the type of environment where people are looking to save on costs. They're focused on, I would say, their cash flow,
right,
and maintaining their cash balances. And when you see big pullbacks like this, private equity gets a lot more interesting. Strategic acquisitions get a lot more.
Guys? Do they just annoy you, or what?
No, actually, I have the utmost respect for them, quite frankly.
I'm not trying to get you in trouble here.
No worries.
Does Nasdaq need to be the lowest cost provider, or really anybody? I mean, is there sort of a value proposition beyond just cost?
No, I don't think so. I think if you look back at our history, we were really, born out of a technological solution. So we're able to provide a marketplace that trades extremely well at a lower cost.